Hello traders, and welcome back to Explain the Charts. Today, September 11th, 2025, we're cutting through the noise to bring you an in-depth analysis of the USDCAD pair, a currency cross that has seen significant movement. The big news dominating headlines is the recent US CPI data and its profound impact on market expectations for a Federal Reserve rate cut. Let's start by looking at the broader picture on the daily chart as we dive into the fundamental news driving these shifts. According to reports, USDCAD tumbled from a 3-week high today, weakening the US dollar post-CPI release. While headline US CPI for August rose slightly more than forecast at 0.4% month-over-month, core inflation remained steady. Crucially, markets viewed this data as insufficient to deter the Federal Reserve from cutting rates at next week's FOMC meeting, with probabilities now exceeding 90% for a 25 basis point cut. This sentiment is bolstered by recent softer producer price inflation, a surge in jobless claims, and downward revisions in prior U.S. job figures, all pointing to a cooling U.S. labor market. These factors collectively suggest a bearish outlook for the US dollar in the immediate term, as interest rate differentials are expected to narrow. Now, turning our attention to the Canadian side, the Canadian dollar has shown resilience, rebounding as this US data reinforced the Fed's easing case. However, Canada faces its own economic challenges, including a weakening labor market and subdued domestic demand. The Bank of Canada is also widely expected to cut rates by 25 basis points next Wednesday, with markets pricing in a roughly 70% chance. A soft Canadian CPI print, due next Tuesday, could further increase these rate cut expectations for the BC. Adding another layer of complexity, oil prices, a key Canadian export, have fallen to $62.47 a barrel due to concerns over softening U.S. demand, which is generally bearish for the CAD. Therefore, while the CAD enjoyed a rebound today, its future strength remains contingent on its own inflation data and the BOC's upcoming policy decision. Let's shift our focus to the charts to see how this news might translate into price action. Looking at the daily chart, specifically the candles leading up to September 11th, we can observe that USDCAD had been in a general uptrend since the lows in late August. The last full daily candle in our data, from September 10th, closed at 1.38601, following a high of 1.38697. The news of today, September 11th, suggests a significant reversal, with prices tumbling from a peak near 1.3892 down to around 1.3845. This indicates a sharp bearish response to the latest fundamental developments, overriding the recent bullish momentum. This abrupt shift highlights the power of monetary policy expectations in driving currency markets. Moving to the 1-hour chart, we get a clearer view of the short-term trends leading into the current day. Notice the upward trajectory from September 8th, where the pair started around 1.37954, consolidating and pushing higher through September 9th and 10th. Price action on September 10th showed bullish momentum, reaching an intraday high of 1.38697 before closing slightly lower at 1.38601. This hourly chart clearly shows the underlying bullish pressure that was building up, only to be sharply interrupted by today's economic announcements. The abrupt shift from this bullish short-term trend to the reported tumble is a classic example of news-driven market reversals. This demonstrates how quickly sentiment can change, making it crucial to stay updated on economic calendars. Zooming in further to the 15-minute chart, we can pinpoint the very granular movements just before the reported market tumble. Observe the period on September 10th, for example, between 12:13 p.m. and 12:58 p.m. Universal Time Coordinated. Here we saw USDCAD attempting to break higher, trading from 1.38574 to 1.38570, then moving to 1.38544. This microtrend shows the market trying to find direction, with some bullish attempts interspersed with minor pullbacks before the major news-driven event. This level of detail helps us understand where traders were positioning themselves right before the significant event. Such consolidation around previous highs often precedes a strong move, either up or down, upon a major catalyst. Now, let's identify some key price levels for USDCAD. The immediate resistance, prior to the reported tumble, was around the 1.3890 to 1.3900 zone, as mentioned in the news as a 3-week high. On the daily chart, this level aligns with previous peaks, suggesting strong selling pressure there. For immediate support, the news points to the 1.3845 area following today's drop. Looking at the daily and hourly charts, a stronger support zone lies between 1.3820 and 1.3830, which has held in late August and early September. If this 1.3820 to 1.3830 support were to break, the next significant level to watch would be around 1.3700 to 1.3720, a level that has provided support multiple times in July and August. Considering the short-term outlook, the immediate pressure for USDCAD appears bearish due to the stronger case for a Fed rate cut. The current market sentiment, post-US CPI, indicates that the USD's appeal has diminished, leading to a downward bias for the pair. We could see USDCAD retesting the 1.3820 to 1.3830 support zone, and a break below this could open the path towards 1.3750 with moderate likelihood. However, the upcoming Canadian CPI data and the Bank of Canada's rate decision next week will be critical short-term catalysts. A significantly soft Canadian CPI or a BC rate cut could potentially cushion USDCAD's fall or even instigate a rebound, counteracting the USD weakness. Conversely, if the BC signals a more hawkish stance or delays cuts, the CAD could strengthen further, intensifying the bearish pressure on USDCAD. For the long term, the daily chart shows that USDCAD has been in a broader upward trend since its lows in May 2024, albeit with significant volatility. The convergence of monetary policies, with both the Fed and BC signaling potential easing, suggests that the pair's direction will largely depend on the relative pace and aggressiveness of these rate adjustments. Should the Federal Reserve implement more substantial rate cuts than the Bank of Canada, we are likely to see sustained downward pressure on USDCAD, potentially towards the 1.3500 to 1.3600 range over several months, with a high likelihood if Fed dovishness outpaces BC. However, if the Canadian economy demonstrates greater weakness, or if commodity prices, particularly oil, continue their decline, this could provide support for USDCAD, pushing it back towards the 1.3900 level with a moderate likelihood, especially if the BC is forced into more aggressive easing. Traders should closely monitor official statements from both central banks, upcoming inflation reports, and global commodity price trends. Key price levels to watch remain the resistance at 1.3890 to 1.3900 and critical support at 1.3820 to 1.3830, and further down at 1.3700 to 1.3720. Always remember to manage your risk and stay informed. These are volatile times in the currency markets. Thank you for joining Explain the Charts, and we'll see you in the next one.